Hello and welcome, grade 11s. In today's lesson, we're once again going to assist you with some exam revision. And for today's lesson, I'm going to cover a question on ratio analysis. So let's get started. Right, now the information that we've been given for this particular question belongs to a partnership. So what I'm going to do, guys, is I'm going to first go through the info and then we're going to start looking at the actual questions. Before I start looking at the information given, just a reminder to please work with me. Make sure you've got your pens, stationery on hand, your calculator in front of you, and remember, the way in which we're going to do this question is obviously together. So let's get started. Right, you are provided with information obtained from the financial records of VT Boutique. The business is owned by partners Vuka and Tanyade. The business is a clothing store and is situated in Durban North. They specialize in elegant designer gowns and smart wear. All gowns are marked up by 100%. So that's a markup that is used. Right, very important, guys, especially for the exam. If they give you additional information about the business, like they've done here, so they've told us that this business has two partners, which they normally do. They normally mention the names of the partners. But if we look further, they've given us information about the product that the business sells. In this case, they're selling designer gowns or designer dresses. So immediately, remember, they are giving you this information because they expect you to use it at a later stage. So make sure you highlight this bit of information. Right, all gowns are marked up by 100%. So the markup that the business uses is given to us at 100%. And again, they are giving you this markup for a reason. They expect you later on to probably use this information. So I just want you guys to make a note of that. Okay, we're going to look at the required in a moment. I want to go now straight to the information. I'm not going to read through everything, but just get a feel for what info has been given to me. Right, I am given, firstly, an extract from the balance sheet. And as usual, I will have the current year, in this case 2015. So let's just mark that as the current year. And 2014, which is the previous financial year. Now remember, guys, ratio analysis, you're obviously doing a comparison between one year to the next, the previous financial year to the current financial year. Right, so I've got an extract of the balance sheet that is given to me, not the entire balance sheet, but just an extract. Right, let's look further. So the next bit of information is an extract from the income statement. So not much given. I've got sales, I've got advertising, trading stock deficit, and the net profit is not given to me. That's missing. Okay. Right, let's move on. Extract from the appropriation account. Remember, guys, appropriation account, obviously, in terms of a partnership, shows you or indicates the way in which your profit, let's be specific, in which your net profit has been shared or divided amongst the partners. Okay, so I'm just going to make a little note of that. Right, so the extract of the appropriation account as at 28th of Feb 2015. So I'm given total earnings for partner Vuka, total earnings for Tanyade. Now again, guys, a reminder, when we talk about total earnings, remember here we are referring to your primary distribution of profit plus your final distribution of profit. Primary distribution of profit, here we're looking at salaries, interest on capital, the bonus that the partners were entitled to. That is classified as primary distribution. The final distribution looks at your remaining profits or remaining loss, and that is also divided amongst the partners according to the profit sharing ratio. So we are not given primary or final, but we're given the total. What's the total earnings? Okay, right, and then on the next page, so I've got financial indicators as at 28th of Feb 2015 and 2014. So once again, I'm just going to remind you, 2015 is the current financial year, and 2014 is your previous financial year. Okay, so I'm not going to go through each indicator that's given. However, immediately I notice that there's certain indicators missing or certain ratios that are missing. So I'm just going to circle that. Okay, just to highlight that those ratios were not given. Right, quite a bit of information given thus far. Right, and then finally on the last slide, I've now got additional information. So additional info that is also given, and as you can see, there's quite a bit of information given. Again, guys, in order to save time, I'm not going to read through all of this, but when we get to the questions, then obviously I'm going to come back to this. But for now, you've got a feel for the info that is given. Okay, right, let's now start with the questions. So the first set of questions, calculate the following ratios for 2015, in other words, the current financial year. So clearly, these are the ratios that were missing. So we now expected to calculate these figures. Okay, let's start off with the first calculation. Net profit on sales should be straightforward. So I'm taking my net profit for 2015, and I'm going to divide this by sales. Obviously, again, 2015, I want a percentage, so I'm going to multiply that by 100. Right, so immediately I'm going to get this information from my income statement extract. So let's go to our information, which we've put on a different page to make our lives easier. So let's go to the extract of the income statement. So I'm looking at 2015. So there's my sales figure, but immediately I notice net profit is missing. So the net profit figure is not given to me. Right, now how am I going to go about calculating the net profit? Okay, below, and I've already spoken about this, I've got an extract of my appropriation account. And again, a reminder, appropriation account looks at the sharing of your net profit. So net profit was shared between VUCA and Tanyada. The total earnings that VUCA received, 103,000. The total earnings that Tanyade was entitled to, 49,000. So immediately, if I add these two amounts up, that's going to give me my net profit. Okay, you guys with me? So in other words, they want you now to work backwards. Get your net profit by adding the total earnings by both partners. Okay, so a bit sneaky, but remember in the exam, this is something that could be asked. Okay, so let's look at total earnings of VUCA, 103,000 plus Tanyade, 49,000, and that should give us a net profit figure of 152,000. Okay, so now that I have this figure, let's now do the actual calculation. Okay, so let's go to our calculation. So our net profit was 152,000. Okay, and we're now going to divide that by sales. So let's go to the sales figure. The sales figure, 745,500. So let's enter that, 745,500. Okay, 745,500. Okay, Right, now remember guys, in the exam, show how you got this calculation. Right, now that I have my figures, straightforward for me to calculate. So I've got my net profit divided by sales, 745,500. Okay, and I want this as a percentage, so let's multiply that by 100, and that's going to give us 20,38 or 39%. So let's round off to the second decimal. Remember, in the exams, they often specify how many decimal places they want you to round off to. I'm going to round off to the second decimal, so 20,39%. Okay, so I've got my first calculation, except for the net profit. The rest should have been quite straightforward. Okay, let's move on to the next calculation. The next calculation wants me to work out current ratio. Now, immediately the current ratio, I'm comparing current assets to my current liability. The question is not asking me to comment, guys. All the question is asking me to do is calculate. Now, we often find in the exams, or when we're marking exams as teachers, students never read the instructions. So in this case, for example, you're asked to calculate the following ratios, and sometimes we find students give us comments after they've calculated. Now, what's wrong with giving comments? You're now wasting time. And remember, in accounting, there's always the time issue. So please do not make that mistake in the exam. So just a calculation in this case. Right, my current ratio, current assets is to current liabilities. So immediately, I'm going to get this information from the balance sheet. So let's go to our information. Okay, and let's go to the extract of the balance sheet. There we go. Okay, so my current assets is given to me at 113,560, and my current liabilities is given to me at a figure of 66,800. So let's transfer these figures to our answer sheet. Current assets 113,560. Okay, 113,560 is to my current liabilities is 66,800. So 66,800. Right, at this stage, you should be very familiar how to do the actual calculation. So obviously, I'm going to divide the right-hand side by 66,800. Do the same on the left-hand side. Divide that by 66,800. And that's going to give me a ratio of, let's get the calculator out, 113,560 divided by 66,800, okay, and that gives me a ratio of 1,7 is to 1. Okay, right, let's move on. The next calculation, debt equity ratio. Right, so your debt equity ratio, also very straightforward. Non-current liabilities are being compared to equity. Now remember guys, what makes up equity? Your capital that was contributed by both partners plus their current account balances, the balances of both partners. But bear in mind that if the current account has a debit balance, you obviously then not going to add, but rather subtract. Okay, right, so once again, the debt equity ratio, we're going to get our information from the balance sheet. So let's start with non-current liabilities. Okay, so my non-current liability, there's a loan from ABSA, 94,840. So let's transfer that. Okay, 94,840. And that is being compared to my capital plus my current account. Okay, so I'm just going to use brackets for this because there's quite a few figures. So let's start with capital. So there's my capital contributed by VUCA, and there's the capital contributed by Tanyade. So let's take these two figures, 275,000 plus 200,000. Okay, 275,000 plus 200,000. Now let's go to the current account. Okay, the current account. So immediately, if I look at the current account, I notice there's my current account. VUCA has a debit balance of 24,690. Tanyade has a credit balance of 23,400. So immediately remember, debit implies that is obviously negative. So minus 24,690. So 24,000 minus 24,690, and then the next balance is credit. So 23,400 is obviously favorable. Let's try that one more time. Okay, 23,400. 23,400. Okay, right, let's quickly get the calculator out and complete this calculation. Shouldn't be that long. Okay, so starting with 275,000 plus 200,000, so that's my capital, minus 24,690 plus 23,400, and that gives me my equity, which is 473,710. Okay, right, so to work out this ratio, let's just bring this figure down, 94,840. So once again, I'm going to divide the right-hand side, this time by 473,710 to get 1. And whatever I do on the right-hand side, I obviously do the same on the left-hand side. So let's do that. 94,840 divided by 473,710, and that gives me a figure of 0,2 is to 1. Okay. Right, we've got one more calculation. I think let's take a quick break, and when you guys come back, we'll look at percentage earnings earned by partner VUCA. Okay, see you guys in a bit. Welcome back, guys. Right, let's move on to calculation D. Remember, we are calculating ratios for 2015, and we're now busy looking at the percentage earnings earned by partner VUCA. Right, so how are we going to do this calculation? So we're going to take total earnings, obviously from or earned by partner VUCA, and we're going to divide this by his average equity. Okay, so let's write that down, average equity. And obviously, this is for partner VUCA. We want a percentage, so we're going to multiply this by 100. Right, let's turn our attention to total earnings. Total earnings was given to us. So if we go to the extract of appropriation, there we go, the appropriation account, the total earnings by partner VUCA was 103,000. That was his share of the profit. So 103,000. Okay, 103,000. And we're going to divide this by his average equity. So average, immediately half of, open brackets, capital for the current year plus the previous year, as well as his current account for the current year and the previous year. So let's start off with capital. Okay, so let's go to the balance sheet. Right, so partner VUCA, his capital, let's just use a different color. So there's my capital. So I'm going to obviously take these two figures and the current account, and I'm going to work out what is his average equity. Okay, right now, guys, there's 4 figures involved. Okay, so I've got 1, 2, 3, 4, and I'd prefer to do the calculation looking at these 4 figures. You guys obviously can show your calculation on the answer sheet. So let's get the calculator out so that we can work out what is his average equity. So we're going to start off with, let's just move this so you guys can see. So we're going to start off with capital, 275,000 plus his capital for the previous year, 200,000. Okay. Equity, or sorry, his current account, there we go. So it's a negative 24,000, so minus 24,690. And then the previous year it was positive because it's a credit balance, so plus 2,350. Okay, so that gives me his total equity, but I want average, so I'm going to divide that by 2, and that gives me the average equity, an amount of 226,330. So let's transfer that amount to our answer sheet. Okay, so we've got an amount of, now remember guys, I've done the calculation already. You guys can obviously write this out. So let's just rewrite this, 103,000 divided by, let's just bring that amount back. Okay, so divided by his average equity, 226,330. Okay. Right, so 103,000 divided by 226,330. Okay, and times that by 100. So his total earnings as a percentage on the equity that he's provided the business is an amount of 45,000 or 45,5%. Sure, can't be 45,000. That's like hectic. 45,5%. Okay. Right, straightforward, shouldn't be difficult. Obviously, you need to make sure you know your formulas, and then you simply apply the formulas to the information, or to the question rather, that's given, and you're able to do the calculations. Right, let's now move on to a bit of interpretation. So we've done the calculations, let's now go on to interpretation. Okay, the next calculation, not interpretation, so there's one more calculation, but quite a nice question because you are often asked this in the exams. Calculate the amount of trading stock shown under the inventory note for 2015. So we need to calculate the value of trading stock or the value of inventory. Okay, so let's look at how we're going to go about doing this particular calculation. Now, in a previous question, we calculated the current ratio, and the current ratio was given to me at 1,7:1. So I'm going to just transfer this information. So my current ratio, okay, and I'm going to explain why I need this in a moment. So my current ratio, okay, was given to me as 1,7:1. Now, if I look at the current ratio, what does this 1,7 comprise of? Current assets. Now remember, if we break down current assets is made up of inventory, trade and other receivable, cash and cash equivalent. So I just want to write that down. So this 1,7 is made up of inventory plus trade and other receivables plus cash and cash equivalent. Now, if we look at the asset test ratio, so if we look at your asset test ratio, the difference between your asset test ratio and your current ratio is, here we are comparing current assets without inventory to your liabilities. So let's pull this information out and then I'm going to explain further. So if we go to our information sheet, 2015. So let's just look for the ratios that were given to us, the financial indicators. There we go. Right, so there we have our asset test ratio, 2015. Our asset test ratio is 0,6:1. So I just want to take that information to my answer sheet. So asset test ratio 0,6:1. Right, now let's examine this 0,6. What is the 0,6 made up of? This amount, remember, is your current assets, but it now excludes inventory, without inventory. So this is made up of trade and other receivables plus cash and cash equivalent. So in other words, the difference between the current ratio and the asset test ratio, if we had to compare the 1,7 to the 0,6, the difference represents your stock figure or your stock ratio as a percentage to your current liabilities. So how am I going to work this out? So I'm going to start off with my current ratio with stock, 1,7, asset test without stock, 0,6. So if I subtract the two, let's get our calculator out. So we've got 1,7 minus 0,6. So that gives me 1,1. So my inventory is made up of 1,1 when I compare this to my current liability. So how am I going to now calculate? Remember, they want me to calculate what is the value of your inventory, not the ratio. But the ratio is going to assist me to calculate the value. So immediately, I'm now going to turn my focus to my current liability. What is my current liability figure? Okay, so if I look at my current liability figure, let's just go to the previous question where we use current liability. The figure was 66,800. That was my current liability. So if I take that through, okay, 66,800. So in other words, my inventory would be 1,1 times the value of my current liability. So in other words, if I take 1,1 and I multiply this by 66,800, that will give me the value of my inventory figure. Okay, so inventory. All right, so let's do that. Let's get the calculator out again. So I've got 1,1 times 66,800, and the value of my inventory, 73,480. Okay, right, now remember guys, again, there's various ways in which you could do this calculation. Right, this is one method that I've used. You may prefer another method, but remember, it's always nice to know more than one method, because sometimes you may only be able, depending on the information given, you may only be able to use one specific method. For example, what I've done in this case. Okay, right, so 1.2 completed. Let's now move on. Okay, the next question. The partners are considering the business proposal submitted by Bazzy. Okay, I'm just going to shorten his name and I'm going to call him Bazzy. Right, now here, obviously, we have no idea what they are referring to. So immediately, I need to go to my additional information. Okay, so let's go to the additional info and then we will read the question that obviously they want us to answer. So let's pull that out. Okay, so my information sheet, I'm looking for additional information. There we go. Okay, right, so this is my additional info. During 2015, the partners decided to renovate the store. Additional fixed assets were purchased and replaced. Many customers complimented the business on the new look. There was also a massive advertising campaign launching the new look store. Okay, nothing about a business proposal. Right, let's now move on. Next information. Bazi, a close friend of Tanyade, submitted a business proposal to the partners. Key points mentioned in his proposal are as follows. Okay, so we've got a third person coming into the partnership and they are submitting some kind of business proposal. So let's look at exactly what Bazi wants from this particular business. He would like to open and run a branch of VT Boutique in Sandton City. So he wants to obviously join this particular business. He wants to open and run a branch of the current business. The capital outlay is 500,000. Okay, obviously going to be expensive if you want to set up a new store. He is keen on investing 300,000 in the business and would like to become a partner. Now remember guys, a partnership, we're talking about a simple partnership, can range anywhere from 2 to 20 partners. So you've got this third person that wants to come in, wants to contribute to the business and wants to invest in the business. Right, so he's keen on investing 300,000 in the business and would like to become a partner in VT Boutique. A loan of 200,000 Rand, however, will be needed to cover the remaining expansion costs. Okay, so right, that's the proposal that he is submitting to the business. Okay, so let's just quickly sum this up. So you've got this third person, a friend of one of the partners. He wants to open up a new store in Sandton and the capital required is 500,000. He does have 300,000 to invest, so that would be obviously own capital. However, he wants the business to take out a loan of 200,000 to cover the remaining cost for this expansion. Right, so that's the business proposal. Let's now go to the actual question. Okay, so the question that is given. They are unsure, so they, referring to the current partners, are unsure whether or not to take out an additional loan of 200,000. Bazi has examined the financial records and is confident that the business will qualify for an additional loan and it will benefit from using borrowed funds. So there's two parts here, right? Firstly, will the business qualify? Okay, will they be able to obtain another loan? And is this going to be beneficial? Is this going to benefit the business? So remember guys, can you see there's two parts. Can you qualify for the loan? Is it going to help the business generate more profit? Right, so the question, briefly explain by naming and quoting two financial indicators why you would support Bazi's opinion regarding the additional loan. Okay, so very, very important. Read your question carefully. They're not asking you, do you agree or do you disagree, like they normally do. Here they're telling you that you agree with Bazi, you support his business proposal, and they want you to justify, name and quote two financial indicators why you would support Bazi's opinion regarding the additional loan. Okay. Right, so I want you guys to think about this. I think let's take another quick break. And when you guys come back, we look at the two financial ratios that's going to tell us that, you know what, this is not such a bad idea. Okay, so I'll see you guys in a bit. Welcome back, guys. Right, hopefully you had some time to think about this. Let's now look at the answer. So which two financial indicators will indicate to the business that they can go ahead and borrow more capital and it's also going to benefit the business? Okay, right, now let's start off with, before we look at the actual answer, which ratio is going to indicate that you qualify, you are able to take out another loan? Think about this carefully. Okay, hopefully you remember the debt equity ratio. So immediately, your debt equity ratio is an indicator of whether the business is low geared or high geared. In other words, does the business rely on borrowed funds, or does the business have sufficient own capital? Now, earlier on, we calculated the debt equity ratio, and if I remember correctly, it was extremely low. Okay, let's quickly go back to it. Right, there we go. The debt equity ratio is sitting at 0,2 is to 1. Now, what does this mean? Remember, 0,2 represents your debt and your equity. Okay, there's my equity. So for every 1 rand of own capital, equity is obviously own capital, the business relies on 20 cents of borrowed capital. So immediately, by looking at this ratio, we can clearly see that the business is low geared. They don't rely that much on borrowed capital. In other words, the banks would consider them to be low risk. And immediately, when you are low risk, you end up qualifying for a loan, or the banks would want to give you additional loan. You don't want this ratio to reach 1:1. Obviously, you want to be low risk. Okay, so immediately the first ratio that indicates that it's fine to borrow capital is your debt equity ratio. Now, let's look at the second part to the question. The second part, remember I broke this down for you. Okay, so let's go to the actual question. Right, so my debt equity ratio tells me that I can qualify for a loan. Now, the second part to the question, this is an important one, and this is where students often tend to go wrong or make mistakes. Right, why do we borrow money? Obviously, we borrow money because it's going to benefit us in a certain way. Now, how does it benefit the business? Because remember, if you borrow capital, you end up paying interest. So how does this benefit the business? You want to use the bank's money, the money that you're borrowing, to generate more profit. So in other words, take the money from the bank, borrow this capital from the bank, use this money to expand your business. Why do you want to expand your business? You want to make more profit. But at the same time, you need to remember that a certain percentage of the profit will be paid towards interest. So you need to ask yourself, the return that we are making when we are borrowing this capital, is it higher than the interest that we are paying? So remember, guys, if that return is high, so for example, let's assume the return is 25% and your interest that you're paying the bank is 12%. Okay, the return is obviously much higher than the interest that you are paying. So immediately, we now need to look at your return on capital employed. That particular ratio is going to tell us whether or not the business will benefit from borrowing more capital. Okay, right, so let's go to our information sheet, and we will talk about this more when we get to the actual info sheet. Right, so the info sheet, there we go. So let's go to the actual ratios. So I'm looking for return on capital employed or return on total capital employed, and immediately there's my return. So the return, when I borrow capital, I'm using the bank's money and my own capital, the return is 32.8%. This is really, really high. But remember, I need to now compare this return to the interest that I'm paying the bank. Okay, so if we go to the balance sheet, okay, further down, there's my balance sheet. So the interest that I'm paying the bank is 13%, but the return that I'm making is really high, 32%. Okay, so are you guys with me? So this particular ratio, return on capital employed or return on total capital employed, clearly indicates that, hang on, the business is going to benefit if they borrow more capital. Okay, because they're taking the bank's money and they're generating enough profit to cover the interest and there's more profit left over for the partners. Right, so let's now put this into an answer, and let's go to the actual answer sheet. Okay, so hopefully all of this now makes sense. So if we go to our answer sheet, the debt equity ratio, just get a pen out. So there's my first indicator, the debt equity ratio, remember name and quote. So the debt equity ratio is 0,2:1. So I've named the ratio and I've quoted the ratio, and there's my explanation. Indicates that the business is low geared, and even after taking an additional loan, remember, if they borrow the additional 200,000, okay, it will still be less than own capital. So in other words, if you had to recalculate the debt equity ratio, you're going to clearly see, remember, Bazzy wants to invest 300,000. So immediately your equity will increase, but debt also increases by 200,000, but you're going to clearly see that the ratio is still less. Borrowed capital is still less than own capital. In other words, the business is still low geared. Okay, so debt equity ratio clearly shows us that we do qualify for the loan. Okay, return on capital employed or return on total capital employed. Remember, in your exams, guys, these abbreviations are allowed. 32.8% is significantly higher than the interest rate on the loan, which is sitting at 13%. And it is therefore to the business's advantage to borrow capital. Okay, so I've explained that already, and I'm hoping that it makes sense. Right, you guys with me? Okay, let's move on to the next question, 1.3.2. Mention 2 factors that Tanyade and VUCA should consider before purchasing gowns from Europe and Asia. Right, so let's go back to the information, the additional information, because we didn't come across this. So let's find this. Right, so additional information. So there's the business proposal. Right, so if we continue reading the business proposal, he has a contact in Europe and Asia to supply the business with evening gowns. The cost price of the gowns is relatively cheaper, and if purchased in bulk, further discounts will be granted. Okay, so still dealing with the business proposal from Bazzy. So he's got a contact in Europe and Asia where he can buy gowns, the evening gowns or evening wear at a lower price, and he can also buy this in bulk. Right, so let's look at the question. Is this going to benefit the business? Okay, so if we go back to the question itself, mention 2 factors that Tanyade and VUCA should consider before purchasing gowns from Europe and Asia. Right, now remember guys, right at the beginning of the exercise, the information that was given right at the beginning, okay, there we go. There's our information. The business specializes in elegant designer gowns. Okay, so immediately, if you look at the customers that you are obviously selling your product to, evening wear obviously costs quite a lot. If you're going to buy this item, you look at individuality. You want to buy something that is original, something that is not going to be worn by someone else. Imagine going to the metric dance and then you end up wearing the same dress that someone else in your school is wearing. Obviously, evening wear, you as a customer, it's not something you buy all the time. It's something that you think about very carefully because you know that you want something in terms of the quality, the look, and so on. Now, should this business buy in bulk? Think about it. I mean, really, should the business buy in bulk? It's not like they are selling T-shirts or jeans everyday wear, where they can buy in bulk, because customers obviously don't care who's wearing the same t-shirt or who's wearing the same pair of jeans. Hopefully they don't. But remember, here we're obviously talking about two completely different types or styles of clothing. Right, so what factors should the business consider? And do you think the business, will benefit from purchasing the gowns in bulk? So let's look at the answers. I'm sure most of you were able to answer this. From a cost point of view, yes. However, the business must consider the nature of the product. Okay, and here obviously we're looking at quality. Right, in other words, the product becomes out of fashion much quicker compared to other items. And remember, I spoke about originality. If the business does not sell, so in other words, they do decide to buy in bulk and the product doesn't sell, the business is then left with too much of stock. Okay, so those are the factors, or this is what the business should look at before are they going to benefit? Right? Do you think from a cost point of view, yes. However, they need to look at these other factors that could play a role. Okay. Right. So quite a nice question, 1.3.3. Let's see whether we can cover one more question. We don't have much time left. Okay. So the next question that is given, 1.4, both VUCA and Tanyade are satisfied with the liquidity position of the business and believe that they have sufficient funds to pay off short-term debt. Also mention if there is a reason to be concerned, quote one financial indicator. Okay, so this is obviously a bit of a mix-up, so I'm just going to move this down. So I'm going to read this one more time. Right, so you've got both the partners are satisfied with the liquidity position of the business and they believe they have sufficient funds to pay off short-term debt. Is this the case? So that's the first part to the question. Briefly explain by quoting 3 financial indicators, right? So this is the first part to the question. And then the second part, also mention if there are any reasons to be concerned. Quote one financial indicator. So there's our second part. Right, I'm probably not going to have time to go to the information, so let's go straight to the answer. Now remember guys, here we're obviously looking at liquidity. Very, very important. You were given a table of ratios and obviously those ratios represent various categories. So when I say categories, I'm talking about profitability, cost efficiency, liquidity, solvency, return, risk. Those are your categories. So here we're referring to specifically, let's just get that back. We are referring to liquidity. Right, so if we look at liquidity, the ratios that clearly indicate that everything is fine, the business has sufficient short-term assets to cover their short-term debt. So which ratios are we talking about here? Here we're referring to your stock turnover rate, indicates there's an increase in the rate at which stock is sold. So here we're comparing 2015 to 2014. Can you see there was an increase? Okay. Another ratio that shows that money is coming into the business. Your debtors are paying the business sooner. Your debtors collection 30 days, again 2015, compared to 45 days 2014. Let's fix that. Okay, so again, another ratio, liquidity showing that everything is fine. The business has sufficient cash to pay their short-term debt. The next ratio, the business is paying their creditors after receiving payment from your debtors. And remember, this is obviously very good in terms of liquidity. So all 3 ratios indicates that everything is absolutely fine. However, there is one ratio that the partners should be concerned about, and we've run out of time, so I'm going to quickly read this. The concern is your asset test ratio. So we did this calculation earlier on, 0.6:1. So this ratio clearly indicates that if you take stock out of the equation, the business obviously is going to battle to pay their short-term debt. So in a situation where stock is not selling, okay, the business obviously may then struggle in terms of cash flow, in terms of liquidity. Okay. Right, guys, I'm afraid that's all we have time for today's lesson. From my side, Mahesh Lal, it's good luck for the exams. God bless, and remember, keep practicing. Until I see you again, it's bye-bye.